Hi everyone, welcome to today's video. So on today's video, we are going to discuss about mutual funds. I will discuss my journey of mutual fund investing, what mutual fund I am currently invested in. I will talk about that also. And finally, we are going to take a look at equal weighted index funds because index funds are picking up in India and you as a rational investor must understand all your options, what are the pros and cons, because sometimes we assume that index funds are super simple. You just put your money every month in an SIP format in the index and you are done. No, there are multiple ways of thinking about index fund also. That is what our discussion is going to be focused on. Super important video. You will understand about sector rotation, concentration in index mutual fund, what is happening in the S&P market in the US. All these very important fundamental points I am going to cover on today's video. Alright, so let's get started. I will speak in 4 simple points. Point number 1 is around my journey of starting and investing in mutual funds. So when I started my stock market journey per se, I started like any other retail investor. I used to invest a lot of money in mutual funds. In fact, all my money in mutual funds only because I did not have the time to research and analyze stocks and keep a track of stocks. So mutual fund was the most convenient mechanism for me in terms of making investments. Now, the biggest mistake that I made in terms of mutual fund investment is, and there is a video that I have done, please take a look, super important video again. You will understand all the basic points around active mutual funds, around passive mutual funds, and you will be able to make better investment decisions. But the major mistake that I made in mutual fund investment was that I invested a lot in active mutual funds. So I used to pay a lot of money in commissions and that depleted my return quite a lot. There were multiple other problems, but one single biggest problem that I'll have to point out is that by trading or investing in active mutual funds, I used to lose a lot of money in terms of paying commissions. Now you might believe that all mutual funds are evil. No, nothing like that. Mutual fund is a very respectable industry in India. It is very well regulated and there are very good mutual fund managers also. On top of that, mutual fund investment, especially for beginners, is almost given, right? You have to do it because if you go on day one, when you start investing in the stock market, you might go and purchase a bunch of stocks. You might also start seeing some profits, but you would not know when to sell it, how to engage with those stocks, and bunch of different problems. So when you are starting out, investing in mutual fund acts as a very good net practice, right? So to say that you start tracking the market, you're not losing your money because mutual fund manager is sensible. They might not give you insane amount of returns, but at the same time, you're not going to lose your money also, right? So it is relatively safer from that angle. So this is a very important point that I wanted to explain. Now, where do I stand? So I've been investing in the stock market for quite a few years now. I would consider myself to be an advanced investor. So over time, as I have improved upon my understanding of stock investing, my mutual fund portfolio has become really small. I'm still invested in a few mutual funds. Some of them are very old because that is when I started and I haven't sold those mutual fund units yet. So they are stuck. From time to time, I also invest in index-based mutual funds and I also take positions in liquid debt mutual funds. So this brings me to the second point, that what exact instruments that I own and what type of mutual fund investments do I still have. So predominantly speaking, there are 2 types of mutual funds that I invest my money in. So the first mutual fund type is called as liquid debt mutual fund, right? Now, why do I use it? Because, for example, if I feel that the market is overvalued and if I have a bunch of savings, then what I would do is that I'm just looking for market opportunities where I can invest this money. So I will park that money. This is more like a parking mutual fund, that I just park my money in this mutual fund. Now they are very easy to withdraw, right? So they are very easy to withdraw. You can withdraw the money very quickly. No problem there. The rate of interest is also fine. No problem there. There is no lock-in, right? It's not as if that you have to keep your money for a certain number of months, all that stuff. And the risk is also low, right? So risk means that, for example, these liquid debt mutual funds are usually invested in very safe instruments. So the risk is also low. Do I make the same returns that I make from stocks from this mutual fund? Absolutely no. But the reason why I'm doing this is just to park my money meanwhile, right? When I'm looking for market opportunities, and I use this instrument very frequently. So this is first type. Second mutual fund that I use in terms of investing is the index mutual fund, right? So index mutual fund is something that I propagate investing in. You should keep a little bit of your money in index mutual fund. I buy very selectively now, and there is a very specific purpose that index fund investing does. It just helps me track my stock portfolio against the index, right? So that is the reason why I'm buying index mutual fund sometimes. And especially again, if I'm not finding any specific undervalued stocks for a certain duration of time, I'll put money in index mutual funds. Now, very quick note here is that if you're a beginner, right, if you're a complete beginner and if you don't know anything about stock investing, mutual fund investing, and if you're just looking for one instrument and you come to me and say that, Akshat, can you suggest like one instrument where I can park my money, which will give me decent returns also in terms of the risk that I'm taking, right? So risk adjusted return. So I would say go and invest in index mutual funds. The commissions are low, the risk adjusted returns are high. So all good things are there, right? So that's the very basic part. Now let me extend the argument so that you understand the concept of index mutual funds really well, right? Because this is very important for you to understand, because people don't have conversation about this part ever, right? Now there are two different types of index mutual funds. One is called as market cap weighted index mutual funds, and there are equal weighted index mutual funds, right? Now very quickly let me again explain to people who are new to my channel what index funds are. So essentially, if you go and buy a stock of ITC, so you are investing money directly in a company. So this is called as stock investing, right? But if you create a basket of 2-3 stocks, for example, you have ITC also, you have HUL also, you have Tata Motors also, and this is packaged in a mutual fund. So this is a basket that you are buying. That particular basket buying is called as mutual fund buying, right? Now, these mutual funds can be of different types. When it comes to index, for example, in India, we have indices like Sensex and Nifty 50, right? Nifty 50. So, for example, if you are looking to buy a mutual fund, which is Nifty 50 mutual fund. Now, this will have top 50 stocks from 50 companies in India. So, that is what Nifty 50 represents. That this is the basket that you are buying. So, if you go and put 1000 rupees in Nifty 50 index mutual fund, what are you buying? You are buying these 50 stocks, right? Of Nifty 50. So, I hope this point is clear that what exactly it is that you are buying when you go and invest your money in an index fund, right? Or rather a Nifty 50 index fund. You are essentially buying top 50 stocks or top 50 Nifty stocks in India. That's it, right? Now you have two choices in terms of buying your index fund. Now you can do market cap weighted index mutual fund, or you can do equal weighted index mutual fund. So let me explain both these things, because this is very important for you to understand, especially given today's scenario. Now, if you're buying Nifty 50 market cap weighted index fund, what are you buying? Now, this is a list of Nifty 50 stocks and their weight, right? This is very important. So, if you put 100 rupees in this Nifty 50 market cap weighted index fund, what are you buying? You are buying 11.21 rupees of HDFC Bank. Then you are buying 11.17 rupees of Reliance. So on and so forth. So essentially what is happening is that when you make the decision of buying a Nifty 50 index mutual fund, you will feel very happy, but you would not know exactly how much in what proportion you are buying. You are essentially buying, if you are buying market cap weighted index fund, you are essentially buying in accordance with the weight of those stocks in that index. I hope this point is clear. If it's a little complex, please rewind it. You will understand. From an example point of view, very simple. If you are investing 100 rupees in a market cap weighted Nifty 50 fund, you are buying 11.21 rupees of HDFC Bank. Because why? Because HDFC Bank's weight in Nifty 50 is 11.21%. So this is the meaning of market cap weighted. Now what is the meaning of equal weighted, right? Equal weighted. So again, you have second option of buying a Nifty 50 index fund, and you can choose to buy an equal weighted mutual fund. I will put some links in the description box also for you to check. Now here what is happening is that, for example, if you are investing 100 rupees in this Nifty 50 equal weighted fund, then how much? You are buying 50 stocks. And you are only spending 2 rupees per stock. So you are buying 2 rupees of HDFC, 2 rupees of Reliance, 2 rupees of Housing Development Finance Corporation, 2 rupees of Infosys, so on and so forth. So this is the difference between market cap weighted versus equal weighted. In equal weighted, you end up purchasing 50 stocks in equal amount. So I hope this difference is clear. This is very important. You must understand this, because it's very important for you, even as a novice investor, to understand where exactly your money is going. Now your next obvious question here will be that, hey Akshat, which one is better? Is it market cap weighted, right? Is it better, or is it equal weighted? Equal weighted. Which one would you advocate and why? Now it really depends on what you are betting on in the market. It's not as if there is some fundamental problem with market cap or there is some fundamental problem with equal weight. There are advantages and disadvantages. So let me very quickly take you through that. So let's first talk about market cap weighted. So let's imagine a scenario where you are putting 100 rupees in what? In market cap weighted Nifty 50 mutual fund. Now what is happening here is that you are purchasing 11.21 rupees of HDFC, then you are buying Reliance, then you are buying Housing Development Finance Corporation, so on and so forth. Now what happens is that, for example, some of these Nifty 50 stocks will do really well. For example, HDFC Bank might do really well, right? Then next month when you are doing your SIP, the weight of HDFC Bank will go up, right? Because instead of 11.21, if its market cap or the share prices go up, then market cap will also go up. So instead of 11.21%, it might become 11.5%. So more of your money keeps getting allocated to stocks that are doing well, right? So what you're doing is that you're doing growth investing, so to say. What you are essentially doing is that you are investing more of your money in stocks that are already growing. Now you might have guessed it right, that if the market is overvalued, if you feel that, hey, the market is overvalued, and something like HDFC Bank, hypothetically speaking, if it has already made its peak and it's not going to go up, then the market might consolidate, or that stock might consolidate. It will not give you adequate returns, or it might even fall. Because if, for example, let's say if these stocks are trading at an all-time high, for example, in the US, FANG stocks, Facebook, Apple, Amazon, Netflix, Google, these stocks have come down. Why? Because they had gained so much momentum after 2020 crash that they had to come back at some stage. So they have crashed. For example, Facebook crashed by almost 15% in a month. So huge loss if you would have invested in S&P market cap weighted index. So this is the biggest disadvantage. The advantage of market cap is that if the market keeps on going up and up and these big companies keep on performing really well, then of course you will benefit a lot, because you are investing more money in companies whose weights are high. This is the primary advantage and disadvantage. In simple terms, what I mean to say is that when you are doing market cap based index investing, then you are getting concentrated. You are taking more exposure to certain number of stocks only. For example, if you go and invest in today's market and market cap weighted index funds, then you are essentially taking 10% position in HDFC Bank. Now you tell me whether it makes sense to invest 10% as per today's rate in HDFC. Your answer might be yes or no, right? So that is the primary advantage and disadvantage, and the major issue with market cap weighted index fund is that they have concentration risk. Now comes equal weighted Nifty 50 index. Now in equal weight, what happens is that you are investing 100 rupees and only 2 rupees get allocated here and so on and so forth. Now what is happening here is that when the market goes down, for example, and whichever stock is performing badly. So for example, let's imagine that if ITC falls for some reason, and then market cap of ITC becomes only 2%, then what are you doing? You are still investing in an undervalued stock. So this leads to something called as value investing, right? That you are still investing equal money in stocks that are falling or rising. Therefore, you end up taking positions in undervalued stocks also. Another way of thinking about it is that you invest money in HDFC Bank also, whether it goes up and down. So here you have the possibility of catching these undervalued stocks, so to say, and you are orienting your portfolio to companies that are getting beaten down. So these companies, because they have fallen, they can go up, leading to a boost in your holding. So this is the primary advantage, that this is called as value investing. So you are taking more positions in beaten down stocks. So this is the primary advantage of equal weighted Nifty 50 mutual funds. Now if you say that, okay, Akshat, given the market circumstances that markets are hitting an all-time high and I feel very uneasy taking like such big positions in HDFC and Reliance right now. These are great stocks, no doubt about that. But right now markets are hitting all-time high. But do you really want to take such large positions in these type of stocks? If your answer is no, you will ask me that, okay, what are my options in terms of making investments in equal weighted Nifty 50? So I'll put some links in the description box, but you predominantly have two options. So the first option is that you buy via the mutual fund route. So you buy Nifty 50 equal weighted mutual fund, right, or index fund, right? So this is simple mutual fund. So you go and place an order from a mutual fund house and you can buy this. The second route is Nifty 50 equal weighted ETF, right? Exchange traded fund. Now exchange traded fund versus mutual fund, what is the primary difference? Now mutual fund is a mutual fund, very obvious, right? That there will be a fund manager, this, that. With ETFs are essentially like stocks. If you have a trading account from Zerodha or any other app, then you can go and purchase this ETF. It's very similar to how you buy stocks. So the way you go and buy ITC stock, similarly you can go and purchase an ETF. Now DSP is the first company in India that has come out with this kind of an exchange traded fund. Now these are getting very popular in US right now, these equal weighted ETFs. The reason for that is very simple, that if you take a look at S&P 500, right? If you take a look at S&P 500, and I'll put the link here also, almost 20% of its holding is in FANG stocks, FAANG, right? So what happens is that if this S&P falls down by let's say 10-15%, The S&P will fall by 10%, but these FANG stocks will at least crash by 20% because of their large weight in the index. That is the problem with market cap based indices. Therefore, this equal weighted index is getting a lot of prominence in the US market, and therefore a large amount of money is flowing in these equal weighted indices. So now you might have a question for me that, Akshat, should I purchase like a mutual fund or should I purchase an ETF? Can you quickly explain that? Right, so this again comes down to your personal preference, what you want to do, but very quickly, if I have to explain you the major differences, ETFs are freely traded in the market. They are like stocks and can be bought and sold as per the investor's convenience. And there is real-time transacting of this, because in mutual fund what happens is that you place the order, then the order gets executed towards the end day, then you get delivery in like 1 or 2 days. So all that stuff is there. It's not real-time. ETFs are not like that. ETFs are literally like stocks. Now, fees and expenses, ETFs merely replicate the performance, they do not actively manage. But whereas for mutual funds, there might be some charges involved. But look at the type of mutual fund that you are buying also. This is in general that I am reading out. So, check the links in the description box, you will get an understanding. Now, one more very important point is regarding the lock-in period, that ETFs do not have any lock-in period. That will be true for Nifty mutual funds also, but just double check as per the specific mutual fund that you are buying, whether there is a lock-in period or not. So, essentially speaking, depending on your investment style and what you want to do, you can purchase any of these, be it via mutual fund route, be it via ETFs, be it equal weighted, be it market cap weighted. But I'll just quickly summarize 2 very important points given the current market dynamics. So right now we are sitting at Nifty approximately 18,300. That is the level we have reached. Now market, if you believe markets will consolidate or markets are likely to fall down, then maybe taking exposure in equal weighted index fund might make a little bit more sense. Because let me show you the graph for Reliance, right? So you see this period, right, from 2009 to 2015-2016 or like almost 2018, right? So almost 9-10 years, Reliance's stock did not move at all. It barely moved. And Reliance has a big weight, a huge weight in the market cap based index fund. Now, if you purchase such stocks and take very high exposure to it, your returns will turn out to be very low. So, under such circumstances, when the markets have gone up quite considerably and you feel that the markets might consolidate or might come down, it might make sense to diversify in the truest sense. So, equal weighted index might give you returns from that perspective. But if you believe in the story that, stock consolidation is not going to happen and the stocks are going to go up, and the consolidation might happen after quite a while, then you can invest in any index fund. It should be okay. Most rational approach would be to mix and match and take little bit of positions in equal weighted and little bit of position in market cap weighted index funds. So that is what my recommendation would be, because it gives you a lot of diversification. So I hope you enjoyed the video. Please give it a thumbs up and share it with your friends, and I will see you the next time.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.